We're delighted today to have a seminar that focuses on a very interesting issue on commodity price shocks, uncertainty, and bank lending behavior. And to that topic, we have leading experts who've been researching this area for quite some time now. I have the pleasure to introduce both speakers who are here. Let me start by introducing my good old friend, Dr. Anthony Simpasa. Simpasa is a great researcher and has established himself so globally. I've had the pleasure of knowing Simpasa for now many years, I could say, having been a colleague together at the African Development Bank, and also having been a key participant, research leader within the Africa Economic Research Consortium. But today, he is the African Development Bank lead economist for Nigeria, positioning all the research that happens in the country and in Africa. So basically, that means he leads the knowledge work and the policy dialogue and advisory services of the African Development Bank to the government of Nigeria, and also leads on the analytical support to organizations like commercial banks operating in the country. He holds a PhD in economics from the University of Cape Town, and an MA in economics from the University of Botswana, and a BA from the University of Zambia. And before joining the African Development Bank in 2011, Anthony was a manager in market studies in the financial markets department at the Bank of Zambia. We actually, I think, joined the African Development Bank in the same year. He has also been a visiting scholar at the International Monetary Fund in Washington. So he comes here with a lot of expertise, knowledge, having combed the research for almost 20 years now, and has published in a number of esteemed journals in our profession. He's now a member of the African Economic Research Consortium, a member of the Global Development Network, and also a research fellow at the South African Institute for Policy and Research. So we welcome you, Anthony, to this seminar. And Anthony has indeed researched and co-authored this paper with the Dr. Martin Nandelenga. And Martin is a senior policy analyst in the Department of Trade and Foreign Policy at the Kenya Institute for Public Policy Research and Analysis, KIPPRA, which is the leading think tank, the premier think tank in Kenya. He holds a PhD in economics from the University of Cape Town. Before joining KIPPRA, Martin was a lecturer in economics at Egerton University in Kenya, but he also consulted widely for the World Bank, the African Development Bank, the United Nations Development Program, UNDP, with research interests in the area of public finance, financial economics, financial markets, international trade, economic modeling, and big data science applications. He's also a member of the African Economic Research Consortium and a principal consultant at the African Review of Economics and Finance, RF, in Johannesburg. So we are honored today to have these two distinguished researchers share with us the work they've been doing on not only commodity prices, but implications for bank lending behavior. So let me call upon both of you gentlemen to start your presentation. Meanwhile, for housekeeping, please post your comments, questions, feedback in the chat. and after the presentation, we'll come back to you to have a dialogue, question and answer, and discussion. Thank you very much. Anthony and Martin, the floor is yours.
Thank you, Prof, for very encouraging words of introduction. I'm not too sure that I deserve all the accolades that you have showered onto me. You've really dressed me in borrowed robes, but thank you so very much. I deeply appreciate it. So really, Martin and I have been thinking a lot about this subject matter, and we're very grateful that Prof, you have kindly agreed to give us a platform to share our thoughts with the rest of your network members. This for us is a very important undertaking, just to be able to receive feedback from people that have been working in this kind of space for some time. So Martin and I have really been thinking deeply about this for some time, and when the invitation to share with you and your team members our thinking in this area, we are very excited. And we said, well, this is, I think, an opportunity that we cannot miss, because Prof's team is so widely read and well vested in this kind of research, and we took the opportunity with both hands. So we're glad to be here, and we are not in any way seemingly underestimating this chance that we have to engage with everyone on this call. So the presentation really is structured very briefly along these lines. So I'll provide the introduction and also some information just to motivate our study on the macroeconomic situation that the country has gone through over the past couple of years, maybe a decade or two, just to contextualize what we will be talking about. And then Martin will come back with some technical elements of our study on the methodology and how we have used the data and the transformations that have been applied. And then I'll get back with the results and the rest of the presentation. So that's the format of our presentation today. And like I said, ours is really to just share with you the draft of our thoughts for now, and it should be seen in that light, because we are really just waiting to hear what everyone on this call will say about what we've done so far. Those of you that are familiar with the Zambia's economic landscape and the historical evolution will appreciate that this is a country that solely depends on copper for exports and the fiscal revenues, at least to some degree now, mainly because now the mining industry is in private hands, and the only source of revenue is through taxation. Yeah, so, but we also appreciate that the macroeconomic uncertainty really does affect both financial and economic decisions in a very profound way. And shocks such as the global financial crisis that affected the commodity prices, as well as the current COVID-19, which has a very profound effect, not only on the health situation, but on the economic situation as well, has implications on the performance of different segments of the economy. Specifically for the global financial crisis, you will note from many that have conducted research along these lines that the dry up in credit and finance in general was very, very significant and created a lot of ripple effects to the rest of the economy. But also, we know that the severity of the credit crunch depended to a large extent on the policy response to the crisis. And although this mainly affected the advanced and emerging market economies, those in the developing world like ourselves in Zambia mainly felt the impact of the global financial crisis through the commodity prices and its transmission to the rest of the economy. And specifically for banks that are exposed to resource sectors, and in this particular case in Zambia, those that are exposed to the copper sector were obviously affected. They had a shrinkage in the balance sheets, increase in non-performing loans, and so on. And so at the time of the global financial crisis, we know that the Zambian economy and credit to the mining sector more generally declined as a result of what we just described. And we have seen a similar outcome, obviously, during the COVID-19 pandemic. And globally, Reinhardt recently put out a paper that shows that the non-performing loans in Africa were about 11% of gross loans in 2019 in pre-pandemic era. But given the exposure of households to non-financial, non-bank financial institutions and the erosion in the balance sheets and asset values of households and smaller firms, the ratio of non-performing loans is most likely to have been higher with the pandemic. And that certainly is the case in the case of the Zambia. And so we sought out to just assess to what extent bank lending in Zambia really is affected by commodity price shocks, but also the uncertainty in the macroeconomic environment more generally. And I think the case of Zambia is a very interesting one. Like I said, Zambia is an export commodity. I mean, commodity exporter, copper in this case. But more importantly, in around 2005, 2006, Zambia received debt relief under the Heavily Indebted Poor Countries Initiative. And for some time, this was probably one of the few episodes that the country enjoyed a sustained increase in macroeconomic stability. The debt relief created kind of a soft landing for the economy, and we saw a number of improvements across board. We saw suddenly an increase in banks lending to households, for instance, because all of a sudden the government, because of the debt relief, they no longer needed to borrow as much from the domestic banking sector in order to provide for the fiscal deficit, but also that released the resources because banks were saddled with a lot of liquidity and they had nowhere to take it. So they had to explore different avenues of how to dispose of that liquidity. And given that the exposure to the households and individuals was very limited previously, this was the segment where a window of opportunity opened up. So we saw a great increase in the lending to the households and to the private sector more generally. But the reverse of fortunes within a space of 2-3 years after the hippie completion point, with the commencement of the global financial crisis, we saw a complete retrenchment of banks lending, because also the impact of the commodity price shock that accompanied the crisis was such that there was increased risk aversion in the banking sector more generally. Like I said, many of our countries really experienced the shock gradually through the foreign commodity prices. And we'll see in empirical work just how this has turned out in the case of Zambia. And the pandemic has kind of replicated itself in terms of the risk aversion. In response to the pandemic, the central bank provided an equivalent of 500 million to support those businesses that had been affected by the pandemic. But we have seen a little uptake of this facility, mainly because these companies are still mired in a lot of uncertainty, a lot of decreasing demand for their goods and services. And banks are wary of lending or even accessing this facility to on lend to this kind of depressed economic situation. But what's surprising is that in both the situation, the global financial crisis and also the pandemic, the policy has been more procyclical. And that is to say that we have seen a lot of expansionary fiscal policy. In part, you'd argue, especially during the pandemic, is to mainly support distressed households and the social sector that needed government support. But the economy, even prior to the pandemic, had already been in a downfall situation from about 2015, with the coming of a more populist regime, if you like, that really went on a spending binge, focusing largely on infrastructure. But this infrastructure was rolled out mainly through external borrowing. And so the pandemic just compounded an already stressed macroeconomic situation. So we want to kind of put all this together in a more compact form in this paper. And we believe that, to our knowledge, this is the first, at least empirical attempt to bring together commodity prices, certain macroeconomic environment, and how that affects bank lending more generally. And we use a very unique data set that we have been privileged to access the Bank of Zambia's data. Part of this work also was part of the PhD thesis that I used. So we have extended that data to the current years, because it's at bank level, and so it's easier for us to trace some of these effects at bank level. And we use several proxies of uncertainty consistent with the literature in order to ascertain the differentiated impact on economic outcomes. We seek to basically answer three key questions in this paper. Investigate, of course, the sources of macroeconomic uncertainty, and we highlight two key ones that we believe speak more to the case of Zambia specifically. And also we assess the bank's lending behavior and how this changed during and after the financial crisis, and how it has responded to macroeconomic and commodity price uncertainty. And then, because the Zambian banking landscape really is very dichotomous, with the large banks on one hand, very large banks on one hand, and smaller ones that really hover around in smaller markets. So we want to assess whether there is a more differentiated or heterogeneity in the lending across bank sizes. So very quickly, and some of this I've talked about in my intro, is that in 1990s, Zambia embarked on a very ambitious reform program with the coming of multi-party democracy. What we saw was that the initial reform agenda was really very aimed at tackling the fiscal profligacy that had characterized the previous regime of Dr. Kaunda and his team. And so the shift to indirect tools of monetary policy, fiscal prudence, and so on helped really change the economic landscape with the growth in the economy. But also it was assisted by the increase in copper prices in the initial years of the reforms. But by the late 90s, we had seen the reform momentum lose pace, and we saw a complete reversal of the initial years of commitment, such that by 1998, GDP per capita was very, very low, and the ODA had slumped to just about $35.3 in terms of per capita, largely because of governance concerns that donors had expressed with the government at the time. And we saw obviously the decrease in terms of trade with the copper prices declining during that time. And that prompted, in a way, Anglo-American corporations exit from Zambia after 100 years of operating in the country. But for some reason, the exit of Anglo literally coincided with a complete turnaround in the international copper market. Copper price really took another 4 or 5 years of steady increase from about 2002 to about 2005, 2006, which led to obviously an improvement in the terms of trade. And you will see from the chart that is before you. But the reformist government that took over in 2001, although it was the same party, but with the change of leadership, took a very complete path of reforms and basically re-energized the push for the heavily indebted poor countries, which culminated in the debt relief in 2006. Yeah, and these gains of the reform gains before HIPPIC were consolidated in the years that followed, but also with the support of rising copper prices. And we saw GDP growth averaging about 80% between 2005 and 2009. And the consolidation of monetary policy helped reduce inflation for the first time in 20 years to single digit of about 9.1%. It had been below that in about April of 2006, and with the reduction in debt, we saw a complete fall in debt service, which kind of also attracted foreign capital inflows and the appreciation in the foreign exchange rate, But more importantly, the stability in the macroeconomic environment helped reduce sovereign risk. And what we saw was a large inflow of capital inflows. And you see in the next chart here that the total non-resident holdings of treasury bills, and I'm giving the case of treasury bills here as just for illustration, because we saw foreign participation also at the equity market. But the non-resident holdings of treasury bills increased from basically about 6% in 2005 to about 17% the following year, although subsequently there was an ebbing of that. But that just demonstrates the kind of attraction the Zambian economy had received over the years. But the crisis really kind of led to the global financial crisis, led to a retreat of all these inflows, and we saw an exit of many of these non-resident holdings and liquidating their holdings in the government securities. But one thing that many people have associated Zambia with, especially the macroeconomic situation, was the debut of the Eurobond in 2012 of 750 million, which was hugely oversubscribed. You know, the government wanted 750 million, but the book order was $12 billion. So you can see the attraction of foreign investors to Zambia's sovereign assets at the time. And riding on that, the government issued 2 more bonds, one for 1 billion and the other one for 1.25 billion in 2015. But this was at the same time that the government had embarked on a large borrowing spree, and the focus on reforms had literally broken down, if I may use that way. And so we saw a complete downward spiral in the economy from about 2006, with the debt build up both commercially and official debt, but mainly commercial debt borrowed from China and others. And you see that by 2021 rather, commercial debt accounted for about $6.2 billion, which was about nearly 40% of total debt, including 3.1 billion, which was not in bond form. And with the fall in macroeconomic situation, the continued borrowing, and basically the shrinkage in fiscal space, basically led to the government default in 2020 November on its first Eurobond payment of about 42.5. This has been touted as probably the only one thus far, the default in the pandemic era, as many would put it. But I think it was already in the pipeline, because Zambia's fiscal and debt situation was really very precarious at this stage. So, and the default literally just exacerbated already fragile macroeconomic situation, resulting in the downgrade from Zambia's rating agencies. The onset of the pandemic, like I said, just compounded the situation, which was already in a downward trend. The chart we have here just give you a snapshot of, we try to trace the evolution of the copper price from at least the 1990s to the latest situation, and it gives a timeline of how the price of copper has evolved over time. And you could see during the HIPPRA reforms, what I talked about, the steady rise in copper price, which coincided, which basically helped support the reforms that were in place precedent to the HIPPRA debt relief that I talked about. And then you see a sharp fall during the global financial crisis and the recovery soon after. But 2011 to 2015, we saw that decline again. Although now the country is enjoying another steady rise in copper price, reminiscent only of the post 2019 era. 2009 era, as it were. A very quick snapshot on how banking sector has performed since the 90s is that clearly, with the banking crisis of the mid-90s, 1994-95, the Bank of Zambia implemented one of the most wide-ranging and sweeping reforms to improve the performance of the banking sector, leading to strengthening of prudential and regulatory oversight. And we have since then at least observed stability in the banking sector, and also entry into the industry of foreign banks. In 2012 and 2000, there were only about 13 banks, but now we are talking about 18, 19 banks, and only 5 of these are locally owned by local investors. But what we also know is that the largest 4 banks really hold a significant share of the market. Although there has been a dilution of asset composition or asset holding, the concentration ratio has now declined to about 54% by 2019. But importantly also, we have seen the fall in interest rates, in cost of finance more generally, but also in the yield rates at treasury bills. Although this coincides with, in a way, how the performance of the economy has been over time. You could see that the treasury bills as well have followed a similar path of the macroeconomic performance, but also of government's fiscal position or fiscal stance, which basically also influences their participation in the domestic treasury bill market. Here is just a summary of the banking sector indicators. I talked about concentration ratio, which has declined by about 20 percentage points. But we see also that loans account for about 40% of total assets. Not so much change from 20 years ago, but we have also seen a rather increase in government treasury bills. securities more generally, bills and bonds, to about 22% from 12% in 2000. And this just highlights the growing appetite for the government to borrow from the domestic banking sector to finance its deficit. In 2015, the ratio was on about 13%, but as I said, from 2016 onwards, the government just went on a borrowing spree, and you could see a jump in the share of government securities in total assets of commercial banks. Much of the revenue is earned through bank loans, and is split between 54% for loans and government securities. So these are two major sources of banks' revenues. And also the lending to the private sector accounts for more than half. To individuals now is about 30%. Not so much change from about 2010, but it has increased for about 10 percentage points since 2005 that I talked about when there was that huge increase prior to 2005. The lending to the central government net of this is direct loans, not government securities, is only 0.3%. And to others here is a multiple of the parastatals, which are not included in the private sector, and largely actually reflects parastatals like the energy utilities, the water utilities, and other statutory bodies, account for about 15%. So this just highlights a summary of the performance of the banking sector in Zambia. But one thing that we wanted to highlight was that the growth in lending to the private sector, and specifically to households, rose sharply during the HIPPIC period, as you could see from the chart on your right. And this was in response to relative improvement in the macroeconomic situation at the time, and much of that borrowing was to salaried workers. Because of the improvement in the macroeconomic situation, the risk profile of this segment of the market was more favorable. But as we said, during the global financial crisis, we saw a huge reduction in borrowing, in lending to both households and private corporations, although the growth to households was much higher than it was to private corporations at the time. So in a way, the performance of the banking sector and other sectors more generally really responded to boom-bust macroeconomic outcomes that are characterized by government's procyclical policy stance. I will give the floor to my colleague Martin to just highlight what methodological framework we have put forward to respond to the three questions that I talked about and the data we've used, and then I'll come back with analysis of the results that we have produced based on this tentative exercise. So Martin.
Thank you so much, Anthony, for that good and elaborate presentation, especially bringing out the stylized facts of the Zambian economy. Now, so I pick out from there, in terms of the theoretical framework that we are following, we are building on the bank optimization problem, which basically constitutes the firm's investment behavior. And we are following Abel 1983. The assumption here is that firms operate in a perfectly competitive environment. Of course, in a developing country like Zambia, it's very difficult to justify why or justify that banks are operating or firms are operating in a competitive environment. But because some of the empirical evidence, especially Anthony himself, has done some work with some evidence suggesting that the Zambian banks earn their income under conditions of monopolistic competition. So, of course, using perfect competition, it still works, but the evidence that is there shows that they operate under monopolistic competition. So based on that, we approximate the perfect competition scenario to monopolistic competition and follow Talavera 2012 with the optimization problem, which basically captures the bank's expected stream of profits, as well as the loans that are advanced and the labor that is employed within the farm industry. Next slide. And go to the next slide. Yeah, so under the optimization problem, we know that bank hires labor at a cost to be able to undertake its intermediation function, and it also borrows interest. It borrows money at a given interest, and it lends that money at an interest which is perfectly elastic within the loan market. So the profit function of banks, as we know, is a function of the loan, of course, the cost attached in terms of the labor hired, as well as interest of the money that is borrowed. But in terms of application of this optimization problem, we assume that the production function of the banks follows the Cobb-Douglas production function. And in this case, as we invoke or use the assumption of perfect competition, we get the equilibrium in terms of the loan market, which is driven by the demand and supply in the market. So following through what I just explained in terms of the objective function and the profit function, if you take the first order conditions, then and followed with the partial derivatives, we can be able to inform in terms of the elasticity in terms of the loan demand, which informs on how it oscillates between 0 and infinity. And it also provides or helps to visualize in terms of the behavior of the bank on how they optimize for purposes of enhancing their loan portfolio. Now, the model that we are using here is a panel econometric model. So we are using the fixed effect model. In this particular case, where we have the dependent variable as a loan to asset ratio. And the other variables, the independent variables, we have the measures of uncertainty. And as my colleague Anthony has alluded to them, we have the copper price uncertainty. We're also using other macroeconomic indicators, that is inflation and exchange rate uncertainty. Then we have also brought on board some bank-specific variables, as well as including some variables or factors that may influence bank lending in the banking industry. We also try to capture the fixed effect, but more so we, in order to be able to mitigate on unobserved bank heterogeneity, we also capture using the clustered standard errors, so that at least it can be able to address the heterogeneity that may arise from the banks or the banking industry that we are operating in. Now, to operate the fixed effect, we have also undertaken the Houseman test, just to be able to inform whether we should use the fixed effect or random effect. But the Houseman test shows that we should use the fixed effect, and that's why we resorted to the use of the fixed effect. And also, in terms of robustness, as you check in terms of the results that Anthony will talk about, we have also implemented the pooled OLS, just to be able to compare the results, whether they are speaking to each other and they are consistent with the theory. Now, the data set that we are using quarterly data, basically collected from Prudential statistical returns from the Bank of Zambia for a number of variables, which include the loans, total assets, bank capital, liquidity, the non-performing loans, the 91 treasury, bill rate, inflation, exchange rate, and copper prices. So as I said, the inflation, exchange rate, and copper prices are basically to change in terms of the uncertainty and how it influences the performance of the banking sector in terms of bank lending. Now, our dependent variable, as I said, is a ratio of loans to assets. And all these variables, the way we have used them is, first of all, we have taken them as a ratio. For example, capital, we have taken it as a ratio of total assets. So is liquidity. For the non-performing loans, we have taken it as a ratio of loans. And then for the uncertainty, to generate the uncertainty, we have used the GACH model, the GACH 1.1 model. First of all, using the monthly data. Let's go to the next slide. Using monthly data. With the monthly data, we run the GACH model, and then we extract a conditional variance. This conditional variance, which is in month, we now convert it into quarterly through averaging, which gives us a series at a quarterly level, and we use it in the analysis of the model that we talked about. So the conditional variance here is very important. It's a good candidate compared to using the unconditional variance, because the importance of it is it contains previous period information set, which can be able to track the level of uncertainty and how that uncertainty moves, for example, from copper prices and finds itself in terms of the bank lending channel. And again, it's important because banks determine their loan to asset ratio with anticipation that there could be future shocks, and therefore using conditional variance helps us to inform, as I said, the information that is there. Now, as we implement our analysis to be able to capture the various scenarios that have happened in the Zambian economy, we have looked at the global financial crisis and be able to understand how the banking sector has been affected. We first of all divide our analysis into the global financial crisis and the post-global financial crisis, just to be able to see how the uncertainty has affected the bank lending in the country. Similarly, we also disaggregate our analysis to specific bank size. So in this case, we are using the large banks and small banks. We categorize the banks in these categories for reasons that, first of all, the number of banks are small, and therefore it was not possible to have both small, medium, and large. Given that the number of banks are few, we have, when you look at the data we are using from 1998 to 2000 quarter one, you find that within that period, there were a total of 22 banks, but a number of banks were merged in between. Similarly, a number of banks also closed. And then on the other hand, to make it so that we can be able to track the policy movement across the period, is we consider banks that were there 5 years before, at least 5 years before the global financial crisis, and also survived after the global financial crisis. Now, in terms of determining the bank size, we determine the bank size by looking at the mean of the total asset of the bank. So if the total asset of a bank falls below the mean, then that gives us a small bank. While if it falls above, then that becomes a large bank. So that's how we have determined the bank size. And of course, this has been used even in Tavera himself when looking at the macroeconomic uncertainty in the Ukrainian economy. He used that approach to be able to divide the banks and undertake the analysis. Now, we have also captured the HIPPIC period, which, of course, based on the stylized facts that Anthony presented, it had an impact on the Zambian economy. But in this particular case, we have captured the period in which the debt relief came in. Of course, before that, there were policy reforms which Zambia had to meet before getting access to the debt relief. So in this case, to be able to see the impact of the HIPPIC relief, that is the debt relief, which came in, so we consider 2006 to 2008 to be able to see whether it had an effect to the bank lending in the country. Now, the other thing we also consider is in terms of the commodity price. And in this case, we are looking at the commodity price fall. The specific commodity we are looking at here is copper. So from the presentation that Anthony gave, the graph was, which showed there was a fall, an elongated fall of price between 2011 quarter one and 2016 quarter one. So we consider that so that we can be able to see whether this fall in commodity, in copper prices also influenced bank lending in the country. And of course, this analysis is taken at a whole sample just to be able to track policy and also at a bank size level, which is actually very, very important. Thank you. Anthony, you can proceed.
Okay, thank you. Yeah, so I was saying that I'll quickly go through the results so we get an appreciation of the empirical outcomes of a methodological exercise. So the GATT model that Martin talked about is really very well behaved, and for both, for all the three uncertainty measures, so I will not spend much time on that. But suffice it to say, the whole sample, which we may consider as the baseline estimation, results really shows essentially our expectations, and that is and these variables are significant at appropriate levels of significance. The A is for significance at 5%, 1%. B is at 5%, and the C is at 10%. So we should read it and interpret it as such. So the baseline model is for the entire sample, the entire period, 1998 to 2020 quarter one. And because of the cleaning exercise Martin talked about, we remain with 13 banks. And with this, we see that the shock to the copper price produces about 16% increase in the banks lending in the baseline model that we talked about. That's the fixed effect model, and all the uncertainty variables, the exchange rate and inflation uncertainty, carry the expected negative coefficients, both of which are significant at appropriate levels of significance. If I may just speak directly to the effect of the copper price, is that this we interpret this as a positive shock, which basically is interpreted as lower commodity price uncertainty. And with the lower price uncertainty, we anticipate banks to respond by increasing their lending, both to the respective sector, but also to other sectors because of the transmission mechanism of higher copper prices to the rest of the economy. And as I said, our measures of macroeconomic uncertainty, the exchange rate and inflation, carry the expected negative coefficient and they're both significant at appropriate levels. And this is reinforced or reconfirmed by the pooled OLS regression that we have. The GDP growth captures the demand effects of in the economy that that helps banks to basically interpret the healthiness of the economy, and we see that also as carrying a positive sign across all the three measures of uncertainty, but also in the fixed effect as well as in the PUDOLS. The ratio of non-performing loans, the capital ratio, as well as the security. Security here is the bank's holdings of government securities, and one would think of this as the effect of the crowding out effect of government borrowing on banks lending. And as you can see, it is very, very strong across all forms of specifications. Then we capture the effect before the global financial crisis and after the global financial crisis. Again, here, the effect of the copper price is retained as positive, again interpreted as a positive copper price shock, but you'll see later during the fall of the sustained fall in the copper price, the result that we get with the dummy there. And all the other variables really are carrying expected signs and comparable levels of significance as well. And the significance of the security holdings just does reconfirm the crowding out effect, and if you like, the flight to quality that may have been occasioned by sensitivity to risk effects of the global financial crisis. At the bank level, what we see is that again, the copper price uncertainty has a higher influence, but mainly on larger banks in terms of magnitude, but also smaller banks are affected positively, but in relative terms with a smaller magnitude to their large counterparts. And the exchange rate uncertainty and inflation and all the other variables, again, are basically carrying the expected signs, both before and after the crisis. What do we see during the heat peak? In the narrative that we provided, we highlighted that the reforms that preceded the heat peak period, but also consolidated during the heat peak period, were really reinforced the bank's response to improved macroeconomic situation and lower risk, both at sovereign level, but also in terms of sectoral idiosyncratic risks, if you like. And the dummy that captures the heat peak period does show the improved lending during this period, with the coefficient ranging from about 0.7 to about 7% across all the specifications. And again, the copper price volatility is carrying its expected sign of positive effect on lending. And the other ones are basically as interpreted and basically reinforce the presence of bank lending and exchange rate channels that have been established previously in the literature, including some of the work that we've done in this space. Across different bank sizes, what we see is that the heat peak period did again carry the negative sign, but we see the influence of the copper price much higher on smaller banks than on their large counterparts. Whilst the inflation is higher on smaller banks as well, but the exchange rate affects larger banks much more. What we think of this is that larger banks really have been heavily involved in or take on large foreign exchange denominated loans, which really may explain why the exchange rate has a larger influence on their lending than on the smaller counterparts. Here is an exercise for the fall in copper price from 2011 that Martin talked about to 2016. And you will see here that the uncertainty in copper price, although it carries the positive sign that we have talked about earlier, the dam itself, which captures this specific period, is negative. Just to highlight that during this period, banks retrenched their lending, than in normal circumstances when the copper price is higher. So we interpret this that in periods when the negative shock to the copper price, banks will basically hold back their lending vis-a-vis the period of reducing copper or increasing uncertainty in terms of the commodity price. A brief discussion of what these results really entail is that we see that a change in copper price does indeed influence banks' lending, and these results are basically corroborate prior studies elsewhere, especially AGRA and others, 2020, that find that increase in commodity prices improves banks' lending. Specifically to our case, the Zambian economy, we see that is really highly sensitive to shocks, especially during periods of crisis. The global financial crisis in this particular instance is a case in point. But also, the results do confirm the presence of the bank's lending and exchange rate channels, as I said, in the country. And the banks with weak balance sheets tend to shift to securities, mainly due to increase in agents' costs. But the shift to securities basically does reinforce the argument that more borrowing from the domestic market by the government does crowd out private sector credit. And the increase in the non-performing loans ratio exposes banks, of course, to negative risk and weakening asset quality. And this problem is exacerbated in terms of high macroeconomic uncertainty, in terms of rising inflation or the exchange rate uncertainty. And this result, we think that it may explain actually the early banking crisis of the early 90s during periods of unregulated lending, which exposed the banks to a lot of delinquent borrowers, resulting in high non-performing loans at the time. And the outcome of the prudential and the regulatory oversight that I talked about earlier has helped limit insider lending and also monitor very closely growth in non-performing loans across the industry. Importantly, the exchange rate channel does negatively influence bank lending, and I think this is because of the indexing that effect that many economic agents use the exchange rate to index a number of price setting, and the banks also look to the exchange rate when they are determining which sector to lend to and how much to lend to in this respect. That is also sensitive to the size of the bank, with smaller banks mainly affected during the global financial crisis, but more broadly, the large banks, because of the large proportion of foreign exchange denominated loans that I talked about, they've been mostly affected, especially during the HIPPRA period when we saw an appreciation in the exchange rate, which basically eroded their holdings of foreign foreign denominated loans. And obviously, the copper price uncertainty does influence more broadly the lending related to the macroeconomic uncertainties. Some tentative policy take on this, and this really must be viewed as very tentative, given the that we still trying to fully understand the implications of this result. But what messages we can pick is that commodity price shocks can propagate strong credit disruptions if not mitigated by increased macroeconomic stability. But what is key is that positive commodity price shocks have the potential to alleviate the negative impact of weakened macroeconomic outlook in terms of inflation, but also depreciation in the exchange rate, especially for banks that are exposed to the mining industry or to assets that reflect the movements in the copper price. The results also underscore the importance and relevance of the bank lending channel and exchange rate channels in Zambia, and they highlight the importance of fiscal prudence to basically limit the crowding out effect that we have observed in the Zambian banking sector. So the monetary authorities should, out of necessity, keep in mind the effect of these channels and also the importance of providing stability to the economy. They may do very little in terms of the copper price shocks, but the policies they take domestically may help to limit the propagation of negative price shocks to the rest of the economy and to bank lending more specifically in this case. So these are the, if you like, tentative results that we have, but we are very encouraged by the sheer intuition and response of these results to theoretical postulations, but also to our own observations of how bank lending has evolved in the case of the Zambian banking sector. So we'll be happy, Prof, to receive feedback on what we have shared with the team, and we are welcome any comments that will help improve both the direction but also the analytical rigor of this paper. So we thank you once again for giving us the opportunity to share with you the our results for now. Thanks.
So thank you very much, Anson and Martin. We are showing applause over the very interesting paper, and in particular the way the paper was motivated. The initial discussion was absolutely helpful in being able to tease out the main macroeconomic developments in Zambia over almost 30 years, and focusing especially on the recent changes, both in the main macroeconomic aggregates, but also paying attention to debt and other aspects. To some of us that have been following developments in Zambia over a period of time, just recall way back that Zambia was one of those countries which were able to deal with or to resolve the question of financial exclusion from global financial markets, i.e., to was able to actually break the glass ceiling of access to global capital markets by floating a bond and getting the bond funded well beyond the level of necessary capitalization. And so these, of course, now I see have some important aspects. The paper also had a very tractable economic theory or macroeconomic theory, grounding, starting from an optimization model and then looking at the various markets, and then also capturing bank lending behavior. And of course, the econometric work is very thoroughly done, looking into taking into account all the proxies and modeling perfectly the forms of uncertainty. So interesting findings. Okay, so now let me open the discussion. The floor, comments, questions, suggestions on the paper. Now we have a chart in Teams, which is just allows you to put your hand up, and I will be monitoring the hands going up and inviting people to share the comments. So please go ahead and indicate by show of hand if you'd like to make some comments. And if you can't find the raise hand indicator, just as I have done on mine, just maybe then please go ahead and unmute and contribute to your discussion. Okay, who would like to go first? Okay, Jaideep, please go ahead.
Thanks, Victor. I just have, first of all, really interesting, and for me, it was, I learned a lot about Zambia because I had never followed the way this exposure was so focused on copper prices for the economy as well. So it was a lot of new things to learn about from your presentation. So thank you for that as well. I have a question about just more of a technicality, really. When you think about the uncertainty of copper prices, and you think about the horizon at which copper miners, for example, might be, contracting their output and so on, or making their plans, would you say that, I mean, like, is there a way to think about it from a different way than just like a gauge volatility, like a spot price volatility model? Maybe should we be thinking about futures prices or some other kind of approach which looks at, like maybe the shape of the futures curve, or in any other way of sort of identifying where this uncertainty really is coming from in terms of copper prices? That's a question that it's kind of an open thought really for me at the moment. I'm not sure whether the short-term volatility captures this uncertainty really. So just if you could sort of say something about that.
Yeah, thank you very much, Jaideep, because if one takes the historical, the future prices, say, predicted in 2005, and then, of course, when predicted during 2000, the future prices predicted for 2005. When you come to 2005, you can see the actual against the future price and see whether that was real. Yeah, so that's a very interesting point. Thanks very much for bringing another angle in which we can view the price evolution process. Anthony or Martin?
Oh, do we take it as they come, or we can maybe wait for one or two more?
Yeah, sure. We can have two more. I don't see any hand up at the moment.
Okay.
Maybe we can take that and come back to other questions from the floor.
Okay. Thank you so much, Jaideep. That's indeed very interesting comment, to the extent that the futures will be more forward-looking and an indicator of how investors will really look at the evolution of copper price and how it affects their investment decisions. I think what we have highlighted here is that although the spot price is really spot, as in instantaneous, but that's, at least for the banks and many other economic agents, probably aside from the mining industry itself, is what they look to, okay? Because when they see a copper price of, say, $10,000 to a pound today, in their own assessment, including the government itself, in their own assessment, this augurs well for fiscal revenue, but also for the healthiness of the industry, for the healthiness of overall. And it does, obviously, highlight what is obtaining in the copper sector. If we had access to the futures data, maybe that would be useful to project to what extent more forward-looking assessment of uncertainty might affect banks lending. But at this stage, we do not have access to that. So, but I think it's a point that we could take into account when motivating why we are using this particular indicator to measure uncertainty, bearing in mind that there are other possibilities that could influence investors, but also other economic agents in assessing the price of copper vis-a-vis bank lending in Zambia. So we take note of your point, and I think it's something that we need to acknowledge in the paper.
Thank you, Anthony. I can see quite a good number of people in the audience who are very much for developments in the Zambian economy. Who is coming next? Meanwhile, we await a second comment. One of the things I appreciated in the paper is the relationship between the exchange rate uncertainty and the copper price uncertainty, and also the relationship between exchange rate uncertainty and inflation uncertainty. I noted that the effects of exchange rate uncertainty on bank lending are symmetric with the effects of inflation uncertainty on bank lending. And this is expected, but is also a kind of indirect evidence of the fact that there would be some very active pass-through effects, i.e. changes in the exchange rate, finally passing through to changes in inflation. And of course, it appears that those have, almost symmetric impacts on the on bank lending. Banks thrive, increase their lending under those circumstances. And I think that's very encouraging. Also, that has important implications not only for policymakers who monitor exchange rate movements and inflation rate movements, but also practitioners, CEOs of commercial banks who monitor their credit policy and credit conditions to households and companies. Any other observations, comments? Am I missing hands showing up, or should we allow people to unmute and speak? I think there is a hand going up. Let me track it. Okay, Esme. Esme Kanyumbu is from the Central Bank, Reserve Bank of Malawi. Esme.
Thank you so much, Chair, and thank you, Anthony and Martin, for the wonderful piece of work. I should admit I enjoyed your work. I was following it at every level, and it's really very informative. It's a very piece of work and has a lot of potential to be extended. I'm just a bit of concerned with the way you measure bank capital and non-performing loans. Jonathan Chipili, my colleague at Bank of Zambia, here maybe can confirm, but I should believe that there are regulatory levels in terms of bank capital and non-performing loans. And I think these benchmark levels have been revised. I don't know for Zambia, but they are revised from time to time. So if you use bank's capital or non-performing loans in that way, I think you have problems. So I suggest that maybe you use any excess above these regulatory levels. For example, excess capital on top of the regulatory, the maximum or the minimum acceptable level. If you talk of, for example, non-performing loans, maybe you could use any non-performing loan, which is maybe above the regulatory level. maybe in that aspect, it will look good to compare from bank to bank, but also maybe it can give you better results. And going forward, on bank sources of source of funding, you have used bank capital, which is quite good, but you could also explore. I think you have rich data. You could also explore other sources of funds from the banks and how they affect banks' lending behavior. For example, you could also explore the ability of a bank to access the interbank market. How would that affect its ability to lend to the public? There's a piece of work that I'm still working on, and it's on Malawi. I'm using data which is close to the data that you're using, and it's coming up clearly that banks that are able to access interbank markets are also able to extend credit to their customers. So I think you could also use that and explore further on the part of banks' sources of funding. Thank you so much.
Thank you, Esme. A very, very interesting question. So, Anthony or Martin, or both?
Maybe let me go first, and then Martin can come back on the use of NPLs and capital. You're right that these are amenable to regulatory thresholds, both capital and NPL ratio. The capital that we have used here, maybe we did not motivate it enough, is the regulatory capital. We may now, if we are to follow the route that you're talking about, we may now have to look at the total capital and the excess over this regulatory capital that we've talked about. Although we think that just looking at regulatory capital itself does help us to understand whether banks are well capitalized, and I think in Zambia it's safe to say that the banks in our sample are fully capitalized, but I think there's no harm in testing the excess of the capital positions over the regulatory threshold. Similarly, for non-performing loans, we can also test the excess over their ratios over the regulatory threshold and see how that affects their lending behavior. So that I think is an exercise that we can always try. Very quickly on the sources of funding, explore other sources other than capital. The interbank market will be useful, but this is really very, very small window of funding that banks use to generate resources for lending. The bulk of the wholesale funding that banks rely on in the specific case of Zambia is deposits mainly. Okay, and the interbank market, or the assets and liabilities vis-a-vis their counterparts, is a very small proportion of their overall assets and liabilities. But for robustness check, again, the data we have, yes, you are right, is rich enough. We can always test the possibilities of these additional sources of funding, as it were. But also the interbank market is mainly an overnight market in Zambia. So I would be surprised if it has a significant influence on how banks interact with the rest of the economy, other than just to finance their day-to-day shortfalls in their liquidity positions. But we can always try this out and see how it turns out. Otherwise, your comment is again well taken. unless Martin has any additional input on this.
Thank you, Anthony. And I think I really appreciate the question raised. I think the only thing I'll add is what we can do is maybe, as you have said, we can do some robustness check in terms of looking at the excess capital, whether it's possible to get some results from there that can form part of what we have, and whether it can also help us tell a story, whether going above the threshold has an effect in terms of bank lending. But the only thing I can add is just it will be important for us to see whether we can do some robustness check. Thanks, based on the proposal. Thank you.
Thank you, both Anthony and Martin, for that response. And thanks, Esme, for bringing in the role of the interbank markets, which I know is your passion. Thank you. Jonathan.
Thank you, Chair. Also just want to thank Anthony and Martin for this good piece of work. Yeah, and I think the results are quite informative and useful for policy. But I think where I stand from the central bank perspective, I just want to appreciate the link between exchange rate uncertainty and bank lending in the manner in which this is handled in the regression. I'm not so sure how lending is measured, whether it's expressed in local currency unit or it's split between local currency unit and foreign exchange denominated loans. Because I said so, the extent that in Zambia that is allowed, that banks can lend in foreign currency as much as they can do in the local currency. So I was wondering whether this inverse relationship between exchange rate uncertainty and bank lending reflects the fact that firms and households are exposed in local currency units, such that when the currency uncertainty increases, then these borrowers struggle to pay off their obligations or to meet their obligations. Or there was an attempt to split lending between foreign currency and local currency, and then assess how uncertainty attributed to the exchange rate would impact the books of banks. So maybe that would just make me more confident about the results that we are getting. Thank you, Chair.
Prof, you are muted. We can't hear you.
Thank you very much. Thank you very much, Jonathan. Absolutely interesting observation on the currency denomination of loans. So, Anthony and Martin.
Yes, thank you, Chair. And I'm glad that Jonathan is on this call. Jonathan, good afternoon, and thanks a lot for your comment.
Thank you.
I think it's people like him that we needed to be on this call.
Exactly.
For obvious reasons. Jonathan is my former boss, of course, but also is a colleague in the research area, especially along these lines. So, Jonathan, I'm very grateful that you're on this call and for your comment.
Thank you.
Yes, we have used the total loans, which effectively combines both FX and the local currency. The FX loans is converted into local currency from the source. So we did not split between FX loans and the local currency unit loans. What we have used here is total loans, which includes both FX and the loans denominated in kwacha. I would want to think that If we are to test just an isolated case of exchange rate uncertainty, specifically to see how banks respond to uncertainty on FX loans, that again is an exercise that can be done, probably maybe in another small piece. One would have to take out the FX component of banks' loans from the total loans, and then it tests this specific effect that Jonathan has raised. It's a very important point, I must say, and I think it would be nice to see just how the FX component of the loans respond specifically to the uncertainty vis-a-vis the exchange rate. So once again, Jonathan, thanks. But what we have used here is total loans expressed as a ratio of total assets as it appears from the source.
Thank you. Thanks.
But maybe before the next we admit another comment, I'll probably maybe just take on Jonathan bilaterally, and we can also share with him the draft of this paper for his feedback.
That'd be useful. Thank you. Sure.
Excellent. Good. Okay. Any further comments, observations? Now, maybe if I could make one observation, and this observation possibly comes from one of my PhD students who is in the call today. It's possible that he's thinking about the same, and I'm just capturing it before he does. In the model, especially the standard models that are being run in this paper, it's always that apart from the impact of uncertainty on bank lending, forms of uncertainty, different classes of uncertainty, there are other important factors which are the conditional factors that tend to influence bank lending predominantly. And one of these in the current literature and the work that Jeffrey is doing is about credit information sharing facilities, because this has changed dramatically in the last 20 years, especially in Africa. And this looks at, for example, the fact that credit information sharing may be both by the availability of credit registry, or which is mandatory, or by the use of credit bureaus, which is not mandatory, but available to enhance banks to get access much information, reduce opacity, and extend their lending. But what becomes very important is that in the presence of mandatory credit sharing versus a credit registry,
yeah. That did Moses go to?
Banks take important decisions. They are able to expand their loans, switch over from collateral-based lending to purely information-based lending. And now just wanted to find out whether this argument, which could be tied down by a variable or a proxy or two, credit information sharing is recognized in influencing bank lending, in addition, of course, to the uncertainty. So the uncertainty would be conditional on information sharing, or it could even be an interactive term between information sharing and forms of uncertainty. And now I'm possibly taking the words of the mouth of Jeffrey, and maybe Jeffrey can add on observations if I have put forward his ongoing work correctly. Jeffrey, have I characterized your research correctly?
Yes, thank you very much, Victor. You have. One, I was about to raise the comment. One of the reasons
I know.
one of the reasons that I didn't, because it's a one country based study. But you are very right. The distinction between the mandatory information sharing and the discretionary one is very, very important. Like you said, I think it will be the issue of information asymmetry cannot be ignored in a study like this. So it will definitely be relevant in it.
Yeah, and in particular, you're right, Jeffrey. In particular, maybe my limited knowledge of Zambia is whether people who have observed Zambia here may be able to tell us whether over the, let's say, 30 years or 40 years, whether Zambia has transitioned from a, say, for example, collateral-based lending to information-based lending, whether Zambia has introduced, in the course of the years covered in the sample, whether they were able to introduce credit bureaus or mandatory credit registry. That depends on what's been happening on the ground. So maybe we can go back to Anthony and Martin for a response. That's a comment on rather than a question.
Yeah, and also another way that can be reflected in the paper is even when bureau or registry exists, another way to capture the impact of information availability is something like collateral registry, which is one of the new online platforms where especially for small businesses, because the difference and the importance of that is that collateral registry allow business to share information about their collateral. So in a way, it does not necessarily mean one can be used in place of the other. So when you have a collateral registry, which means you can combine both technologies, because information on collateral can be shared. So in that case, where collateral registry exists, information can be used from there as well if a registry or bureau don't exist.
Thank you for that. Okay. Anthony, Martin?
Yes, Prof. And I'm speaking at the with the caveat that Jonathan is on this call and he could probably come in and provide additional input. Yes, we have the Credit Reference Bureau now, and also I think that they collect information from potential borrowers, and banks have over the past maybe decade or so starting to be corrected on the timings on when the bureau was established. Have been using some of this information to be able to lend. But especially with the passage of the law to criminalize bouncing of checks, okay, I think to the extent that we are able to pick out the dates, we may not have access to the data, but if we do have access to the data, which I presume is very confidential, we can factor it in. But if that information is not available, we can introduce a dummy that will capture the presence of the Credit Reference Bureau and how banks may have used this information, the soft information that is collected through the bureaus to inform their lending to specific individuals or sectors of the economy. But probably since Jonathan is on this call, he might have additional information that I may not be privy
to. No, thank you very much, Anthony. No, what information I have is exactly what you've just said. And indeed, yes, there have been reforms to strengthen the lending standards. But Shula is in the call. You might want to chat with maybe bilaterally or other people who would want to benefit from what's going on, because she's coming from the supervisory area. She's in the call.
Who is that?
Shula Nandelenga.
Shulamlenga.
Okay.
Shula would react. It's just that whether the correct information sharing can be an important covariate in explaining bank lending behavior. Maybe the bank lending responses were not purely due to uncertainty. They were due to another variable that we may not have captured, in which case information sharing. It's just hypothetical. As a good, it may be a very good hypothesis, but the data may not accept it. So, that's why anyway we have these discussions to explore the scope of the research. Shula Mlenga, do you want to add something here? You are muted at the moment, but
thank you, Professor, and good afternoon, everyone.
Yeah.
Yes, I think
Shula is a very also, in addition to being a regulator, she's a very active, participant in the SOAS weekly reading group, very energetic, absolutely. So please go ahead, Shula.
Thank you so much, Professor, and good afternoon, everyone. Good afternoon, Dr. Chipidi. Thank you, Anthony and for the presentation. It was very interesting. My initial comment was actually to try and also direct you to a paper on determinants of bank credit. There's a paper on the website that was published in November. So if you went to the Bank of Zambia website, you would find a paper on a private sector credit extension. I think you'd gain a lot of insights from that paper. Yes, then coming to the credit registry, it has been in the process of being developed and finalized. I think the process started some time back, as indicated by Dr. Simpasa. Yes, the uptake in terms of banks giving out loans based on the collateral register, I think has been quite low in terms of uptake. Yeah, because of the problems that they have with the asset registry. So asset registry in terms of validation, for instance, the titles of land, for instance, the assets such as movable assets, cars, and things like that. I think the law has some kind of a lacuna. So because of that, the uptake in terms of banks giving out loans based on the credit registry has been quite slow. That's all I can say. Thank you. Thank you, Chair.
Thank you very much, Shula, for those additional observations. I don't see any hand up. As we are coming to the close of this session, let me very much appreciate. There was, before I close, I think there was a comment and observations given by Professor Dark Willem Diterde, who is a professor of practice at SOAS and also a director at ODI. And he had to leave for another meeting, but his comments is very interesting paper, he said, and very interesting presentation. And his observation that the data presented in the introduction seems to suggest that the banking sector in Zambia has been pro-cyclical, which then would be a significant challenge as it has made the global financial crisis worse than it would have been. And so he was keen to find out about the policy responses to the global financial crisis. And his second observation was that, would you suggest that the loans to asset ratio for commercial banks would need to be controlled more actively, perhaps actively lowering them in good times and increasing them in bad times, which is the kind of stop-go kind of a policy? Or should there be a strong role for counter-cyclical action of other financial institutions, for example, development banks, which increase the outlay significantly during crisis, compensating or complementing a decrease in commercial banking? Yeah, I think this is a very good point that we had not explored, but which is worth exploring. And then, or should uncertainty be managed smoothen more actively through other policy measures so that commercial lending is not affected negatively by uncertainty? So those are the observations that Dark made before he left the meeting. Okay, I think I would like to, at this juncture, to thank very profoundly Anthony and Martin for sharing this work with us. I would like to really encourage them to go forward with this work. I think it will end up in a good journal, but also will end up directly with a big policy uptake, especially that the policy leaders in Zambia are here, both KIPPRA and his team, and that's what makes a good paper. A good scientific investigation with high impact potential. Thank you indeed. And thank you all participants for making the time to join us as usual. We are now coming to the end of the seminar, and thank you indeed, and bye-bye.